Welcome back, everybody, to the next episode of the Finance Here. Today, we'll do a little wrap-up on private equity buyouts. I think it'll be pretty exciting to go over 4 different types of deals that KKR did. This is a pretty notable private equity firm. They covered some major businesses in the past 40, 50 years. They've been around they're really the leaders in the space. They've bootstrapped their way. These are 2 brothers with their uncle who launched this business. They did some remarkable deals in the last few weeks, and now they're on the way to raise $100 billion in 2022. They'll be doing a lot more going into this decade in growth equity and technology investments. It'll be very exciting to see what they can do. I think they're a big threat for the venture capital world. I think a lot of guys are going to learn how powerful private equity players can be, their access to capital, their access to resources, management, and getting deals done. It's very exciting to see this. So first up, welcome again. Let me know where you're streaming from, where you are, what your thoughts are. If you got any comments or concerns about technology, investing, finance, economics. I'm thinking about doing office hours, maybe tomorrow on Friday or more on a regular basis. Let me know if I should do that or I should do something else. I'm more than happy to do whatever the audience or yourself thinks is most appropriate. But I love talking about these deals. They're very exciting. I like breaking down the economics, what happens, what works, why it may not work. So without further ado, we'll talk about the first big deal on their books. It's Toshiba. It's a $20 billion business. You've seen this company before. It's gigantic. They used to have these clunky computers, like consumer electronics. They're really competitors with like SoftBank, not SoftBank, but Sony, Samsung, LG, all these other players in the industry, the electronics industry, these Japanese conglomerates, Southeast Asia, China, these guys eventually end up diversifying. Toshiba does oil and energy, infrastructure, a whole variety of different types of investments now. But their technology assets and IT solutions are very much at the core of their business still. A lot of like printers and services and infrastructure management stuff. So the company was founded in 1875. It's one of the largest and oldest in the business. But there's a U.S. hedge fund called Farallon Capital. I think they're based in California. Is the 3rd largest shareholder in the business. They offered a 30% premium to Toshiba's current value. Pretty big. But their 3rd largest shareholder, CVC, offered a 30% premium to buy out Toshiba. But Farallon is not happy with this bid. They want someone to come in, provide a bigger and better deal, more transparency. So I'm going to mention 2 things that are interesting. First, that Toshiba is a Japanese company. That's important to note because what happens in tradition and culture in Asia is very different from what happens in Europe and America. Farallon is a U.S.-based hedge fund. They're gigantic, very, very credible, very noteworthy hedge fund. And then CVC Capital Partners is based in Luxembourg. Very notable private equity firm, gigantic in lending and credit and private equity investments. So for Toshiba to get bought out, we'll talk about a couple of the dynamic problems in this scenario. The Japanese laws and culture have to approve an external party to acquire a business. This problem we saw actually with Renault Nissan, Carlos Ghosn, who's the former CEO of Renault. There were a lot of problems because of the capital base was getting diversified from the Japanese foundation, which in their culture, it's very admirable that they want to retain that culture. They want to retain the relationships and retain the business in Japan. So they're not. I won't say they're open to having external investments if it's not necessary. So Farallon did something. They opened up a bidding war. So the 30% premium since CVC is not enough. It is worth noting that the current, who is now former CEO of Toshiba, Kurumatani, he resigned last week because he actually used to be the head of CVC's Japanese unit. So now we're seeing private equity companies come in, enter the arena. the big one, which we're talking about this episode, is KKR. They're going to come in with a buyout offer combined with Bain Capital, another very reputable private equity firm. Pretty exciting to see that. These two monsters are going to come in, $20 billion business. I saw that Apollo is thinking about it as well. I would not be surprised if Carlyle jumps in. This is a reputable business. You have to imagine $20 billion. Toshiba is gigantic, and it has like 8 different divisions, technology being the prime bread and butter, but has so many other areas where you can just simply either build businesses, you could sell it off to other people interested. You could do so many things with a big business like this. So it's open up for business, and it's very cool to see what's going to happen. And it's interesting to follow this because it's an international deal. So there are a lot of dynamics that are taking place. It's a big deal, and there are a lot of big players involved with this business. So another big business that KKR is involved in, this company just IPO'd today. It's called Applovin. It's a mobile app software development business. It's also a pretty big company. The IPO is valued at around $28 billion. Mobile apps are really hot. It's there's no question about that. Since the last 10 years, smartphones have developed and gone beyond wherever we thought they could. But it's important to note one thing. This ecosystem is owned by 2 players. We know them well, Apple and Google. They own the operating system and the hardware of the smartphones. So Applovin is designed to monetize and manage your mobile apps. They own a portfolio of apps as well. It can be a very lucrative business, but it's very competitive. So this company's been around, I think, for like 10 years. They've 2012 or 2013. They'll raise about $2 billion in their public offering, and they have to do a couple things with that. The 3 things I was able to note from this deal was they, one, have to pay off debt. They're going to pay off about let's see what the number is. It's a couple $100 million it's a couple $100 million. They could raise $1.7 billion in cash. $400 million will be paying down debt, and then they still have about $1.6 billion in debt on the books. So I'm going to go into one of the big numbers. It's a problem in mobile app monetization. The cost to distribute your app to get in front of consumers is very expensive. That customer acquisition, or CAC, as SaaS investors like to call it, is becoming more expensive. For Applovin, the cost jumped 130% to $555 million. $112 million from that is coming from the payment processing fees. And this is important to note. Last summer, Epic, the founder of Fortnite, the creator of that video game, had a big legal lawsuit with Apple because they said that this dispute is still ongoing, that Apple has monopolistic concerns on their marketplace, that they're charging 30%. It's very like usury type of fees to get on the platform. It's very tough to approve things. A whole variety of obstacles that make it challenging to monetize apps, and then your cost of doing business is increasing. So I don't have very good prospects on Applovin. I think this is a very tough marketplace. It's kudos to these guys for even attempting to enter this place. But I will mention that this deal is not just didn't IPO overnight. This deal actually had failed to be acquired by a Chinese business in 2016 for $1.4 billion. At that time, if you remember, when Trump was running for office, and there's a lot of things going on in American economics, trade war and whatnot, the Chinese were a concerning party. So there were a lot of assets being sold at the point in time. And there was customer data concern, something similar we saw in, let's see, what's the deal? TikTok in September. Hey, Utpal, nice to meet you guys. Yeah, Kevin, feel free to reach out. Love to hear your thoughts. Always show some love. Hey, Utpal, nice to meet you. So these guys from Applovin were originally going to be acquired for $1.6 billion. They were failed. That deal got broken apart. Instead, the company, the private equity company from China, decided to invest about $800 million in debt, another $100 million plus in equity. Very exciting business. They thought, at that point in time, 2016, mobile phones were still on the up and up. So $1 billion invested in this business. KKR in 2018 decided to invest about $400 million. This company ended up raising about $1.5 billion. Now, 3 years later, after KKR did the investment, they saw that their stake is now going to go from $400 million to $8 billion, 20x return in 3 years. But I still have a problem with this business. It doesn't have good economics. The cost of doing business is rising. It's very competitive. It's great that this is working out for the investors, but I can't imagine working out for very long. A lot of companies in this space. There's a huge graveyard in this space. So it's interesting to see how this is going to play out. I think the Toshiba game, the investment over there, is going to work out for KKR. They've been very strong in this business. All right, so next up is Box.com, another major deal by KKR, just announced in the last few days. Box.com, everybody knows about this, is a very successful cloud provider, a document provider. Aaron Levy is the CEO, very public on social. It was funded by Mark Cuban, I think in 2004, because people didn't want to use, Aaron and his partner didn't want to use USB drives. So these guys have been in the cloud game since day one. They really invented some areas of this business model. But the biggest problem for Box today is that they have not been able to become profitable. It's a very commoditized business. It's very competitive. They target enterprise users. So it's actually a better business model than Dropbox. But they just haven't been able to get something sustainable over the last 15 years. So they've been struggling for the past several years. So an activist hedge fund came in, Starboard Value, very prominent activist hedge fund. They came in, said, hey, you got to do something. We're going to change the board, maybe change the CEO. The company is not performing at the level it needs to be so that we could be successful as investors. And I think that's the right motive. You have to be a catalyst for change as an investor. So Box.com, Aaron Levy, and the team decided that in May they're going to have a Dutch auction, which is an opportunity for shareholders to sell their stock directly to the management company. So Box will buy directly. In this case, they'll buy out Starboard Value's shares. So it's a form of green mail in some sense. And the problem is that Box.com doesn't have enough capital. They can't fund this. This is a $500 million acquisition. So KKR is coming in, providing them with the capital and the liquidity. It's not free money, which is the catch. So they got the money. They're going to do the deal. It's going to happen in May. But here are some things that you should know about this deal. There's a convertible preferred stock. Currently, I think Box is trading around like $20 per share. KKR, very savvy investor base, comes in, says, we're going to give you $500 million. Here's the caveat. Our strike price is going to convert at $27 per share. So the preferred debt is going to go into equity. And they're also going to get paid a 3% dividend. They have some time period. I think it was like 2 or 3 years. I think it's 3 years before this is a forced conversion. If it converts, KKR will own 11% of Box.com, which is a pretty big stake. Box.com had to use this as their white knight to kind of get Starboard Value out of the picture, because activist hedge funds can move very quickly and do a lot of damage to the team and to the mission. So the Box team had to really sell a piece of the business to get protect their position, and then to actually have someone on their side that understands technology, which is what KKR is doing. And I think they really took advantage of this for the right reasons. So that's very exciting. I don't know what the future of Box.com will be like. I think it's not going to perform any better than it currently is. They've had a very long runway to figure that out. Competitors like Dropbox and Microsoft do a really good job in this space already. I love using Google Cloud and so many other cloud providers. I always thought Dropbox was better. It was much more user-friendly to me. Microsoft is actually pretty good as well. And the other guys, a lot of like Salesforce and everyone else kind of offers a cloud solution. I don't see a real reason for Box.com to be differentiated or something. So my gut is telling me that KKR did this deal. They got inside in the company. They will actually probably take it private in the next 2-3 years, since it's a poor performing public company. And they'll probably shutter all the businesses and products that don't make any money. So I think this company will look very different in 5 years. I mark my words on this. I don't doubt that this company is not going to be around in its current fashion like we know it today. So last but not least is another $1 billion buyout by KKR. Huge business. It's one of these sleepy giants. It's an IT service provider. KKR bought Insano for $1.7 billion. There have been about 250 deals in IT services this year so far. There were a couple hundred last year. It's a very popular space. Whether you're buying software, hardware, services, SaaS, doesn't make a difference. There's so many areas that you could attack in this space. It's a gigantic industry. It's very fragmented. The current private equity owners that are selling to KKR bought this business for $190 million in 2015. So those guys have made out well. They did quite a few deals for Insano. So this business has become pretty big in the last 6 years. I think it's a good business. I think combined with the maybe a Toshiba acquisition or someone else, they have a couple other IT solution providers that they funded, provided growth equity to, or just backed. I think this is a no-brainer for KKR. It's pretty straightforward. These deals happen quite often. Like I said, 250 of them have happened in the last 4 months. They have clients like Travelodge and Guinness World Records. So this buyout will do 3 things if you're not aware of how these are structured. First, it gives KKR 100% control. Then they'll recapitalize the balance sheet for this company. So they'll take out like any of the bad debt or clean up the cap table from old investors. And then third, they'll provide them with additional capital to fund growth. So those are pretty standard procedures or drivers for businesses that want to get bought up by private equity. Insano has done a pretty good job of just hitting targets and beating benchmarks. I'll include 3 of their insights of what they've done, so you have an understanding of where this industry is currently in, like what position it's currently in. First up, the cloud services are providing more native app development, so that's pretty standard. I'd see a lot of more of these cloud service providers creating their own applications and software. Second, they're going to focus a lot more on security. So compliance and auditing, we see a major number of clients demanding this. Cybersecurity, everyone knows, is very hot, but I think these guys are going to bet, which was interesting, more on compliance and auditing, which I think is very important. And then the last one is building an IT infrastructure management program for to improve the customer experience, to have better interaction, reduce friction and obstacles getting in front of customers. Which is unique. I think that's necessary. I think ServiceNow is doing that pretty well. I think Snowflake is doing that to some extent, but it's pretty unique to hear about that. So that wraps it up for the 4 major deals that KKR is doing. $100 billion by 2022 is their goal for the next fundraise. We got a breakdown from them of where they're getting the most demand. They're going to do $40 to $50 billion in private equity, 15 to 20 billion in infrastructure, another 10 to 15 billion in real estate, and then 20 to 25 billion in credit. So private equity continues to be their bread and butter. I think it's very exciting for them. I think it's very exciting for all the major players in the industry. There's a lot more to come in this place. There's a lot more investments I can already see that are happening in the next few months. So 2021 and 2022 are going to be very good times to sell your business or be in the space to buy off these businesses, because it's going to get very exciting. So that wraps it up for today. If you got any questions, feel free to message me. I've been checking Twitter and LinkedIn's commentary coming in. Let me know what your thoughts are on the industry, both investing and technology. I'll be doing more of these more often. I'm looking for more ideas. I answer questions on Quora on a very regular basis. So I love to do this. Love to connect with everybody. Thank you for everybody for chiming in. And I look forward to connecting with everybody very soon. So you can always find me on all these socials. It's very simple to just reach out. Feel free. You can watch old videos either on LinkedIn or on YouTube. And today we released a newsletter going into the details of the deals. So you can read about them on the Tech Financier or on LinkedIn today. And then sign up for the newsletter as well, so you can check it out on a weekly basis. So I'll see everyone soon, and hope everyone has a good week. Take care.